US non-farm payrolls for January are expected to come in at 165,000, down from 312,000 last month. Meanwhile, average hourly earnings are forecast to grow by 0.3% month on month, while the unemployment rate is seen holding steady at 3.9%. With me now to discuss is IG's chief market analyst, Chris Beauchamp. Chris, do you think that investors will be paying particular attention to this report, given the fact that we haven't been getting all of the data as normal because of the US government shutdown?
It probably carries a bit more weight than normally, really. We should have a whole swathe of the data by now for the US, and it does make life a bit more difficult trying to work out what the Fed will do next and what the NFP report will mean for the economy. It remains a sort of place as the premier bit of US data for the month, both in terms of the headline job numbers rather, which of course were very strong last month, and of course the fact that wage numbers have been picking up nicely across the US, and that does provide a gleam of hope in what has been a slightly soft patch for US economic data.
So is that the key part of the report that we should be focusing on, the wage data there?
It is impressive, I suppose, for the headline jobs number, how the US keeps beating expectations and how just when you think the US has reached full employment, they get a stellar month like last month. It's not expected to be as strong, but I think that should spook investors. It is, of course, the wages, the fact that we're now back above that 3% year-on-year level for the first time in about 10 years. And if you've got these kind of solid wage rises that are above the pace of inflation, or at least keeping pace with inflation, then Americans continue to spend robustly in terms of the consumer front. So that's good for the US economy, especially at a time when you've got worries that the slowdown we're seeing in Europe and China and Asia more broadly is beginning to feed back into the US.
So you pointed to one of the positive kind of implications of having a strong wage data, which is the consumer side. What about the inflation side? Because that could potentially cause some concern. Do you think if wages are very strong, that's going to stoke concerns about higher prices?
Well, yes, and of course we're about a year from the last panic over US wages and how that would impact the Fed's hiking policy. So we've come from the past sort of 6 to 8 weeks of worry about the Fed in terms of whether they're getting too carried away, and the Fed has looked to pour oil on troubled waters on that front by saying we're not tied to a preset path. But if you do really start to see this solid increase in wages and it starts to feed through to non-core inflation, then there will be questions asked again over why the Fed needs to calm down so much on rate hikes when indeed everything in terms of PMIs, in terms of US wages and inflation is beginning to move back in a more robust direction.
What about the markets? Is there anything in the report that could really move either the equity market or the dollar? Because this month's been very strong, particularly for the major averages in the equity space. Do you think that looks set to continue into February? What could this report do in terms of its general direction?
It seems hard to think that the NFP report this time around can juice the equity markets much more given the strong rally we've had. The big question is, I think, can earnings season push equity markets forward? But if you're looking at the dollar side of things, I think people are probably too pessimistic on the outlook for the US currency at this point in time. They expect the Fed to really rein back its hiking policy, and I don't think that's going to be the case really if you get continued strong numbers. And the Fed's was very cautious, I think, in changing its language. Powell said we will remain data dependent on no fixed path. And that, of course, means that if things do continue to improve, the rationale for increasing interest rates at a steady pace remains. I think if you do get a very strong number, that will perhaps give a bit of a boost to the US dollar in the shorter term, but we'll wait for another couple of Fed meetings to see whether this trend continues and whether it does mean that perhaps the dot plot in the Fed meetings starts to shift back upwards again.
Chris, thank you very much for your time. That was Chris Beauchamp, IG's chief market analyst. I'm Victoria Scholar, and thanks for watching IGTV. It was a torrid 2018 for emerging markets amid a strengthening US dollar and global trade tensions. So, with valuations now looking more attractive, how does that weigh up against the fears of a slowdown in China? I'll be posing questions like these to our panel of EM experts. The guests include Gavin Sirkin, founder and managing editor of Frontier Funds Media and Intelligence, and Paul McNamara, investment director at GAM Investments. Our aim? To uncover the best investment opportunities from equities to forex within the EM complex. So don't miss our show and find out what are the emerging markets to watch in 2019. We'll be streaming live across IG.com, YouTube, Twitter and Facebook. So join the debate and ask your questions using #IGEMChat.